Welcome back, everybody. Welcome to Soar Financially, where we look at the macro to understand the micro. My name is Kai Hoff, and I'm the @JRMining guy on Twitter. Make sure to follow me there as well. And the host or the CEO of the Soar Financial Group. Thank you so much for joining us. And we're joined here in our studio in Vancouver by Robert Sinn. Robert, how do I introduce you? You've been on the program before. You're a professional trader. You're an influencer. You're just a great investor. You know the space. Like, you're a market commentator. It's great to have you on because we've got lots to cover today.
We've got a lot to cover. It's great to be here. It's great to be in Vancouver when it's sunny and the weather is perfect. It makes me not want to be indoors, but hey, I had to come stop by and say hello and see this great studio.
We should have moved this outside. But maybe a certain factor of laziness kicked in there.
Yeah,
right?
There's a lot of stuff to move.
No, exactly. But I was out running in the seawall this morning when the sun was just coming up over the mountains. Just absolutely magnificent. So the city's tough to beat on.
It's a beautiful place.
Absolutely. Thanks so much for stopping by. We got lots, as I said, we got lots to pack into our conversation here. Shooting for 30 minutes. Let's see if we can get there.
All right, let's do it.
But let's start with a holistic view of what is going on. How do you rate the state of the economy? And then we'll sort of trickle down and look at the commodities, gold, silver in particular.
Okay. Yeah, so I think the last 2 months have bored a lot of people, a lot of traders, a lot of investors. The market has not been especially stimulating from a day-to-day, vantage point. In fact, if you look at the S&P 500, it's at 4150. The last time I checked, about 10 minutes ago. A month ago, it was 4150. So we've had a lot of noise, some gyrations, this debt ceiling drama going on, in the States, but really no net change in a lot of things. Obviously, gold went up. It's gone down, but we're still at 1945. I think the Fed is reining back in market participant hopes of rate cuts, this year. About a month ago, the market was pricing in 3 rate cuts in 2023. Now we're down. We might not even get one, right? And that's what the Fed does. They're doing their job of reining in, these looser financial, expectations. And they're doing it because they want to make sure they win the war, with inflation. They want to make sure they don't get looser too soon. And so that's where we're at. With the market priced in a bunch of cuts. Now the market is taking those out and moving them to the following year. And we're sort of moving up and down this wall of worry.
Wall of worry, absolutely. It's interesting. Like, let's talk gold here as well. Like, what is affecting the gold price? But because it feels like, and I've said that in other interviews before, that we as gold investors tried to outsmart the Fed, front run the Fed, and then the Fed came back and just whacked us over the head like a whack-a-mole. Right? It's happened before where gold ran, we got punished. That was what we saw from November to January. We got super excited. Gold ran, markets ran, like junior market ran, and then all of a sudden, I wouldn't say a rug pull, but they just kept hiking rates.
Yeah. I mean, I think at 2080 on May 3rd, the gold market clearly had gotten a bit, ahead of itself. And a lot of that had to do with, there's a lot we don't know about the banks in the U.S. and these, regional banks that have maybe 40 billion or so in assets that focus on one state or one, part of the country. There's a lot we just don't know. And I think a lot of people were very surprised with what happened in March, including the Fed. I mean, the Fed was sort of taken by surprise. It shows how little they do actually understand the financial system, the banking system, and the economy. I mean, they've proven that over and over again in the last 3 years. And just, simply put, it's very hard to understand everything about the economy and, the banks, right? And so, here we are today. And I think that, let's take it back a little bit. In 2016, January of 2016, the gold market was flat on its ass at 1,100 an ounce. Junior mining stocks were completely, wiped out. Nobody wanted to buy a share, right? And then suddenly we got all this bad news from China, okay, early 2016. And the Fed said, okay, actually, we're not going to keep raising rates. We're going to hold steady and see how things play out. And that sent gold from 1,100 to 1,370 in a few months. Gold juniors had incredible runs, a lot of 10Xs across the sector, right? Move forward to 2019, May 2019, gold 1,275 an ounce. Juniors flat on their ass. Nobody wants to buy a share of anything. Fed gets a little worried that inflation is too low. The economy is too weak, and we need to do a little adjustment, and we might cut rates, right? But meanwhile, the market, bond yields, gold started to get ahead of that Fed easing cycle in June, and again, we had a tremendous move up in the sector June through the summer, 3 or 4 month rally that was fantastic in 2019, right? So again, the gold sector gets, in front of the Fed, and it usually does it by a couple months, right? 2020, now this was a little faster. The pandemic happened. It was a very violent environment. Things were very much in flux, day to day, week to week. But same thing, gold bottom March 16th, and the Fed cut that day, cut to zero. And a week later, they did this huge quantitative easing. Basically, we're going to buy everything. We're going to backstop the world, right? And we had all this stimulus coming. Gold went from $1,450 to over $2,000 an ounce in the next 5 months, right? So we have these 3 examples in the last 7 years. Every time the Fed does a pivot and surprises the market with easing, gold goes bonkers. And the junior mining sector does a 10X in 3 or 4 months, right? So we're sitting up for that again, but it's not quite here yet. And the setup will be perfect when sentiment is really pounded into the pavement. Nobody wants to buy a share again. And the economy, is not nearly as strong as the Fed thinks. And suddenly we get some data that proves it, right? And then they'll do a pivot. And I think we're within a few months of that.
Okay. Remind me to follow up on that. I want to zoom out just one more, go talk macro a bit more before we talk micro, meaning junior mining stocks. Okay. Remind me of the encounter we just had outside here while grabbing some water, because I think it was an interesting statement that fits what you just said. David Rosenberg, econ guy Rosie on Twitter, just tweeted this morning, and it fits what you said as well. Why isn't the S&P 500 signaling a recession? Okay. It was a question, and the answer, it is because most economic sensitive areas are down 33%. Transports, consumer discretionary, and banks are down. It's the tech stocks are keeping the market alive. How realistic is that, and how sustainable is that, Robert?
Tech stocks have the lowest cost of capital. They're very light and lean. They don't have to have big, mining operations. They don't have to own, big pieces of land and equipment and deal with, these different, government bodies that we do in the, mining industry. So tech is the place to be right now. They're in an absolute sweet spot for the cycle. But this is like a cycle that I've never lived through. I've never experienced it, where you have basically 5 to 10 stocks, the largest companies in the S&P 500 driving the whole thing. If the rest of the sector's caught up, we wouldn't be at 4,150 on the S&P. We'd be at 5,000, right? But you have these, mega caps like Apple, like Amazon, absolutely are cash cows, and everybody wants to own them. I don't think that's a healthy market environment. I don't think that's a sign of a great economy. There's lots of, sectors of the economy that are quite, soft right now. So this is like a market cycle, a cycle that we've never seen, and so there's no, reference point. We love to look back at the past to see what could happen in the future, but there's no precedent for this right now.
Okay. There's one more sentence in his tweet, and it said the sectors I mentioned are behaving as they did from 1990 to 1991, in 2001, and 2007 to 2009. We're seeing the same sort of happening right now. Tech bubble. that burst in 2001. We've seen the same sort of scenario. Do you see the AI boom sort of cause a crash at some point when we're looking at maybe real earnings and like the companies that are flying, as you said, Microsoft, NVIDIA, anything with AI in its name, right?
AI, I think, lowers the long-term rate of inflation. I think it has to lower our long-term, our long-term estimate of what inflation is likely to be. Now, I have no idea how it's going to affect the market and the economy, big picture, but I think the last thing we need to worry about right now is inflation. And that's the thing we've been worried about nonstop for 2 years. And I see these Fed speakers in the last couple of weeks talking about inflation and we haven't made enough progress and stuff. And maybe that's right, just looking backwards. But we were at 9% on the CPI a year ago, and we're under 5 now, and we're heading under 3. So I think that the thing that has hurt stocks and been the big worry of the last year has been inflation. That's no longer the worry. So what is there to worry about? The economy and the Fed has tightened too much, I think, is the thing that's going to be the next thing to worry about. And that's why I like gold.
Liquidity, I think, is the key word in general, because I had that in other conversations as well. And sorry to jump in there, but small business owners that require debt to finance their ongoing business concerns because they need to buy inventory or something, right? They're struggling because all of a sudden their debt cost of capital just went through the roof. That has changed. So
and the regional banks are tightening up, right? So they're not as able to lend.
Because that's where let's say the mom and pop bakeries go to say, okay, I need to buy a pack of flour, or I'm exaggerating obviously, but they go to the small regional banks. They don't call JP Morgan up and say, hey, I need to buy a sack of flour or something.
Exactly.
Right?
Exactly. There's a lot of things that are going to be felt over the coming months that are just at the forefront right now. We're just starting to hear about them, and I think the back half of this year is going to be one of the economy is really not that strong. I mean, it's held up to this point, but the weakness is gonna really start to show up, and I think that's where we get the long talked about Fed pivot. I mean, in some sense, the Fed already pivoted in March with this bank, lending program, which expanded their balance sheet over $300 billion in a few weeks, right? So in some sense, that's a little bit of a pivot, but they're trying to be careful here. They really don't want to make the same error the Fed made in the 70s.
Okay. All right, let's put a bow around that because it's an interesting discussion. We can talk macro all we want. We haven't even talked about geopolitics and what is happening like east of us here, right? That's a whole different can of worms that goes also into the gold price, in my opinion. And then CBDCs, de-dollarization are topics as well, because the US dollar is surprisingly showing some strength going into the debt ceiling discussions here as well. Maybe we spend a second on that, actually, the debt ceiling, because there's a decision looming. I think today is May 25th. We got about a week before either shit hits the fan, meaning default, right? At least on paper. I don't know how that's going to play out. Or we get an agreement. Like, what's your scenario, and how is that affecting what we're doing here?
I think the debt ceiling just simply adds to the confusion of everything and the lack of confidence that most market participants have right now. I mean, because so you're trading, and let's say I buy a gold contract, on a chart setup, and then an hour later, some debt ceiling, headline comes across the tape and screws up my chart setup. It's just, there's no way you can forecast these headlines from, Washington. And frankly, I believe they will come to a deal. The deal might have to wait until after the weekend, which is obviously not great. And if it does get pushed out until June, maybe markets head lower on Friday. I don't know. But I think we will come to a deal. I think they have to come to a deal. I think they know that, but how we get there is obviously very tricky. And frankly, I don't have much confidence in any of these people. I mean, these are people that would not be hired for top roles at any major company in the US. period. Yet they're making the decisions for our country. It's quite ironic.
Career politicians,
Yeah,
eh?
yeah.
That's interesting topic. Interesting topic. But if you're American, so remind me. But we've seen furloughs, government furloughs, national parks closing, teachers being furloughed as well, like government workers as well. Do you expect that to happen at all? Like,
I think that's the last straw. Like if we get into mid to late June, that's what will happen. That's what they'll have to do.
No.
And that would be horrible optics for Washington and for both parties. No. And they could blame each other all they want. But at the end of the day, when people stop getting their paychecks, that's when the shit hits the fan. So I don't expect it will get to that because it's just so bad. Okay,
perfect. Talking about so bad, let's talk junior mining stocks and sentiment. Okay,
you made me spit out my water.
That's right. Let's talk about so bad because we just had an encounter here in the kitchen as well, just grabbing the glass of water, and CEO said, "Well, I put out some news yesterday, and we traded 0 shares. Okay, like 0. So." And you made reference to that. Volumes are low. TSX venture volumes are extremely low. Uncertainty. I don't think we have thrown in the towel yet, but it feels like we're awfully close.
Yeah, it does. It feels like we're awfully close. The volume has been drying up since April. We had a nice little run there off the early March low, went into April, and then it feels like it's been drying up for over a month. Volumes have been falling for weeks now, and there are some stocks, it's like they trade by appointment. Stocks that used to trade 200,000-300,000 shares a day are doing nothing, or 10 or 20,000 shares now. I think combination of the seasonality, we're at the end of May, people go out and travel for the summer. I think that's part of it, but also it's just sentiment sucks. And at the end of the day, the junior mining sector is a risk-on sector of the market, and obviously gold price drives it to a large extent. And when gold is rising, that does help. But when gold is rising in an environment where small cap stocks are doing poorly in the worst part of the market, that's not great, and that's what we've had, this year. And then when the Fed funds rate is 5.25 and the 30-year fixed is over 7, it's a risk-off environment. Quite frankly, the Fed is really not trying to stoke the market and trying to get Ethereum back to 4,000. The Fed doesn't want to see that, right? And so the junior mining sector does suffer, as a result of that, because at the end of the day, it's a zero revenue industry. These are companies that are doing work to explore to make a new find that will be worth a lot more someday, but it's not today, right? So they need to tap the capital markets for financing, and that's what's so challenging when the cost of capital has gone up.
How are you trading these markets right now? You're an active trader. Like, I'd probably just walk away, sit on the beach. Like, you're in Miami, fortunately, so you can do that, right? But like, I've been looking at my summer program. It's like, why bother? To be honest, like, and what will it take to change that? And stock picking obviously is extremely important. It's not, you can't just buy an index anymore, in my opinion. At least for the next 3 months. Again, my feeling, right? How are you doing it? Like, how are you trading? What's your advice in trading laps on CO.ca and other, like, Twitter?
The first few months of the year were actually pretty good. There were a lot of opportunities as the year wound down at the end of last year. There were a lot of great setups that carried into January and February. So that was a great time. I would say since the banking crisis in mid-March, the quality of the market environment has gotten gradually worse. And how am I trading it? Well, right now, very carefully or not at all. I was traveling on Wednesday, so I didn't trade. This morning I bought one stock, but it's not a great environment. To be completely honest, it's not a great market environment. It's not a great trading environment. As I said, the S&P 4150 a month ago, 4150 now, no net change. So unless you are just going to be trading for 3 or 5 point moves, up and down and staring at the chart constantly, and then as you do that, you're going to get hit by these headlines, that come across, every couple of hours that might stop you out. It's just not a high percentage environment. And a lot of traders I talk to are also having a tough couple months. And a lot of people are pulling back and say, I need to step back from the market. And yeah, so this is a tough market environment.
I talked to two companies yesterday trying to raise capital. One is a spin out from an existing company trying to raise $5 million. And I can't remember the second one off the top of my head, but it feels like they're going to be struggling. And I've said it in other conversations as well. It feels like it's a go big or go home kind of scenario. You can raise $20 million. We've seen bought deals. Actually, we've seen record amount of bought deals this year already for bigger chunks of money. But grassroots explorers, junior, smaller companies trying to raise $1 million, $2 million here, struggling, almost impossible because it doesn't make a difference.
Yeah, nobody wants to fund the high risk stuff. The sector is, high risk period. But if you have a, resource, especially, if it's a large one, you have what's considered to be a top tier project, it's much easier to raise capital. But if you're doing high risk, really, early stage, sort of exploration, it's not a favorable environment at all. I think a lot of people just would rather pass on that right now. And that's unfortunate because, as we know, with copper and these other, metals, we need a lot more of it in the next decade, and we just don't have it right now. So we need to do exploration. That needs to be funded, but it's increasingly challenging.
Absolutely. What are, if you want to share some of the setups you like right now? What are you looking at macro wise, meaning commodity wise, but also maybe a couple stock ideas like setups if you want to share?
Yeah. I mean, what the best setups, historically in the precious metals and mining sectors are usually when the sentiment is very depressed, the charts are oversold, and you're near a key technical, level. So like, for example, so just hypothetically, just throwing out this possibility. Let's say the next couple of weeks, gold gets pounded down to 1900. That's a big round number level. It was a previous high back in 2011. Let's say that sets up. Nobody wants to go to own gold. Chart doesn't look good. Downtrend for the last month. That would be a setup that I'd be attracted to, right? And I would be looking to buy some of the big gold miners. Also, failed moves have worked well. So let's say a stock has key support at $40 a share. The chart moves down to $39.70. So the support is broken, but then it moves back above 40 a day later or a few hours later. So that's a failed move. And very often we've seen those turn out to be great trades. So it might have dropped to, $39.70, but now it's over 40. Buy it, with a stop, $1 lower or something. And very often these kinds of setups have worked very well for nice gains, right? Mm-hmm. So I feel like we could be setting up for some of these failed moves in the gold mining sector. We're not there yet, but we could be there next week or the following week. I think sentiment is negative. I don't think it's, super bearish, extreme.
Yeah, it's like it's that oversold. You used the word oversold. It doesn't feel like we're oversold yet. No, it's like capitulation, throwing in the towel.
We haven't
It
seen,
doesn't feel like we're not far off of it, I think. But
we're not at October 2022 or March of the pandemic crash, right? We're not quite at that extreme yet, but it feels like it's setting up for that, right? It feels like it's setting up for that. And it could just go higher from here. Like, who knows? Stocks I like. So in the junior mining sector, I like the, Yukon, explorers. I think the seasonality at the end of May and early June is really good. I mean, again, just for a trade, buy something like white gold or Banyan gold or fireweed zinc, and look to hold it for 2 or 3 months, right? See how things play out. I think all three of those stocks are definitely not overbought right now. All of them are quality, and the seasonality is favorable, right? And they're going to be putting out a lot of news over the rest of this year, So I like those, plays.
Fantastic. No, shareholder of Banyan and Fireweed Metals, by the way, now.
Fireweed Metals.
They changed names recently.
Yes.
So,
of course, I know that.
Right? So I'm a shareholder of both those companies as well. So glad you mentioned them. Same opinion, by the way, as well. And Banyan already started putting out news ahead of the season, like perceived season. They put out a resource yesterday. So good stuff. Robert, fantastic conversation. Really, really enjoyed having you here. Thanks so much for coming up to Vancouver. Thanks for taking the time.
Thanks for the invite. And I'm going to steal one of these copper bars on my way out.
Please don't. I love these. Like, they're so cute. I got a 5 kilo one at home as well.
A kilo of copper.
Worth $5 or $8 probably. But it looks nice.
Yeah, it's worth $8.
Right?
But it's heavy and nice.
Exactly, right? But the premiums are insane on it.
Oh yeah.
Premiums are insane on copper bars. Perfect.
Thank you.
I forgot. You also have a YouTube channel.
Oh, yes. So Goldfinger Capital.
I was going to say, where can we find more
Find
of you?
me on YouTube. So I've had this channel for a few years, but I recently changed the name of it and added some photos, and I put out a lot of content in the last 3 or 4 months. So every week or two, I put out a free video, just post it on there. It's, totally available for the, public. And it's usually some sort of market commentary, whatever's on my mind at that point in time. There's no set schedule for it, but it's free content and you get my best thoughts on there. So
fantastic.
Please.
Yeah, absolutely. And
sign up.
People can find you also at CEO.ca,
CEO.ca.
at Goldfinger, and
CEO Technician.
On
Twitter, on CEO.ca. Yes, I'm Goldfinger. I'm Goldfinger.
You got to work on your identities there.
So that's another thing. I think I'm going to streamline them all.
Okay.
So we're gonna do that in the next couple of weeks.
Fantastic. Awesome. Robert, it's good to see you. Thanks so much for coming in. Everybody else, thank you so much for watching Soar Financially. We hope you understand now what is happening in the market just a little bit better, just to make some better, more informed investment decisions. If you like the conversation, hit that subscribe button right there in the corner. It says subscribe on it, or hit that little eagle thingy, our Soar Financial button there as well on the video. Highly appreciate it. Let us know what you think is going to happen as well. There's a comment section. Happy to refer to also, or send over the comments and questions over to Robert as well. We'll get those answered. Thank you so much for tuning in. We'll be back with lots more.